It's 1 o'clock. Time to get started. I'm Geoff Dohrmann. Welcome everybody to the second in our series of quarterly updates on the National Council of Real Estate Investment Fiduciaries ODCE Index. We have about 630 participants that have signed up to participate in the program. So again, welcome everybody. ODCE, as you all know, has become the benchmark for so many of you who are tuning into this webcast. And we thought it would be great to have a regularly scheduled quarterly update on what's going on with ODCE, because it's hard sometimes to get that kind of information. You know, more specifically, what's happening with property investment fundamentals at the fund and property level, and where the index is likely to be headed based on where those fundamentals appear to be trending, as well as things like, what the cues look like, all the basic things that you'd want to know about what's going on with the index. Our presenter for these webinars, as was in our first one, is Garrett Zdolshek, who spent the first 10 years of his working career as a senior consultant for Cortland Partners, which is now part of Stepstone. Garrett was one of the 3 members of Cortland's investment committee and was involved in approving all client recommendations and consulting-related decisions. He also has been a member of NACRE for his entire career, and for many years served as a member of our editorial advisory board. For the past 6 years, however, he's been a member of the senior management team at IDR. As the senior portfolio manager of IDR's programs, he's invested in virtually every ODCE fund. So he obviously needs to be an expert on ODCE in terms of what's going on in the ODCE universe. In fact, ODCE is all he really focuses on, so he's eminently qualified to talk about this particular topic. We should note again that our plan is to produce a video presentation which we'll post to our websites, that those of you who aren't all that familiar with ODCE can use as a primer to help fully understand what the index is all about, and also to help other people in your firm who may need to know but don't really understand what ODCE is all about. Throughout the seminar, or throughout the webinar today, you can pose your questions to Garrett on the fly to the Q&A icon that's at the bottom of your screen. So just pop a question in there when you want to add that to the mix, and I will then pull the questions and post them to Garrett. So even though we can't have everybody live on screen, you can still participate in the dialogue and discussion by asking questions or even posting comments. So look at this as a two-way street, not a one-way street. I think you'll get more value out of it. So meanwhile, just to get things going, allow me to introduce you all to Garrett, who's going to lead our program today. Garrett, thanks for joining us.
Oh, Jeff, thanks for having me again. Jeff, last quarter, we discussed the third quarter, and I think we spent some time kind of discussing the history of ODCE and kind of how we got to where we are today. For this discussion, I thought we would stay with the 3 main topics, except last time we talked about the history, then where we are, kind of the fundamentals, and then the future with a bit of the capital flows and where we are going. I thought this time we'll really dive down more into the performance. We have 2020, there's a lot to talk about, a lot happened or didn't happen as we sit in our homes. And so I thought we'd spend more time today talking about some of the attribution performance of ODCE, what drove returns or drove negative returns, that kind of thing. The second part is the fundamentals. And I, for one, was actually pretty surprised by some of the things we saw when we were looking back at fundamentals. So I'm pretty excited to kind of have that discussion. And hopefully the audience, please give us your comments, questions, feedback. This is, as Jeff said, this is really meant to talk about ODCE and be a two-way street. So we absolutely are looking for your feedback, comments, anything we should or spend more time on or whatnot. With that, I'm looking forward to being here.
Great. Let's go.
All right. So I will jump right into it and figure out how to share my screen first. All right. So as I mentioned, the agenda will cover these kind of 3 main topics, and we'll jump right into ODCE kind of year end. Where are we for the past year? as we look at the kind of high level, and we'll go from high level all the way down into returns, relatively flat, I think as would be expected with certainly the number of properties, slight increase, occupancy, down a little bit. I think of note, two funds entered the index. So the index, even in difficult times for property markets, has grown. New investors, new funds, new managers, which is great. And leverage is largely unchanged, even with some decline. So, slight uptick in leverage, but not much. I think the big news is, for the year, basically, ODCE has now limited leverage to a 35% cap, down from 40, which I think is very consistent with the mission of, stable, cash flowing kind of assets. From a property type, again, I think, nothing of huge surprise, but I think it's important to look at the ever-changing kind of landscape as it goes, because, pretty soon you look back and it moved 5% rather than 1 or 2%. So, office, as expected, is down a little bit, apartment unchanged, industrial up 3.2%, which I think is pretty meaningful for an index of this size. Managers certainly spent a lot of time working on acquiring a lot of assets, industrial, to make it move that way. Retail down almost 2.5%, and of course, other up slightly. From a geographic diversification, and again, this is very high level. I think kind of two main themes here as you look. West is up slightly, growth markets in the West, like Texas. East is down, like New York CBDs. The South is up slightly. Again, the kind of attractive Sunbelt markets, Florida, Carolinas, Georgia, and the Midwest, again, cold weather, down a little bit. Overall, I think the geography, we expect many of these trends to continue on both the property type and the geography, as we go for the next year or two, with industrial increasing more, office and retail decreasing more, and then certainly in the Sunbelt markets and the growth markets, and even the Texas and low tax groups increasing as well.
Now, what is the other category? What's in the other category? Yeah.
Sure. So it's really the catch-all for everything else. It includes hotel now, although there's very few hotels and likely none at some point. But everything from hotel to a big component is self-storage. We're starting to see more medical related, like medical office and life science, although it's a bit mixed because you do see some of that also in the office category. So other is really a catch-all for anything that's not big enough to be a major trend yet. But, things like life science, we think, are getting categorized a lot more closely, as it becomes a more interesting sector, and even it could include a little bit from the storage side in terms of, like cold storage or even, something like data warehouse.
And which two funds were added this last period?
That's a great question, Jeff, and I think that brings us to a great point. As we look at this approach, you're never going to hear us mention a manager by name. We view this as unfair on both sides of the category. So, NCREIF publishes who's added and who's not, if you dig through the research. But as a policy for us, we just feel it's unfair to ever mention someone, even in a good or bad light, as they're just not here to talk about it.
But if participants want to know, they can go to the NCREIF website and find out. Yes. Yes,
if they're a member of NCREIF, they can certainly go in. Look it up, and research is out there, and the managers are not shy about issuing press releases and the things as well, which is great. And we're all for it. Again, we just don't view it as our place to use their names.
Right. Now, one of the questions from the audience is that when you're looking at these graphs, these charts that you put up, that's up there right now, the two graphs, are those based on the number of properties, or is it based on the square footage or some other measure?
Sure. No, great question. And that is actually another nuance. We always delve into nuances the farther we go. And so it's actually based, I believe, now on gross asset value of the assets. For a while there, it was based on net at one point in the index, but now it's based on gross asset value.
And then medical office, is that in the office category or is it in the other category?
It's mixed. So there's not perfect categorization, if you will, as far as we can tell. And so we believe it's actually mixed and in both categories.
And this data that you're looking at is not data that you took raw and then interpolated. It's the data that's aggregated by NCREIF. And so you're basically reconstituting data that was given to you by NCREIF, yes?
We do both. We use the NCREIF data. We certainly look at it as a check, but we also are invested, so we have the fundamental data ourselves as well at our level.
And do you expect the other category to grow? In other words, this is a diversified core fund. And now we've got these other things that would have been considered non-core in the old days that are now being part of core asset.
Yeah, I don't know that core necessarily means a specific property type by any means. Hotel was in this index, in a core index. And, I think the mission of core is to produce stable income producing cash flows. And so I think as the market evolves, as we evolve as investors and managers, we're all looking for that profile. And as we learn and the economy evolves, so too will the exposure, which is great. And so I think as we learn, hotels are a bit less stable and maybe not as core-like, whereas, just because it's a new sector like life science, does that mean it's not stable? I don't think fundamentally that means that by definition. So I think you'll see managers, grow. The other thing we're talking about even now, and a couple, funds have bought even in other are single family residential. That market has evolved and I think is understood a lot better. So yeah, absolutely. I think other is more than 50% of the REIT market, of the public market indexes. If you look at it, I don't necessarily think that, means we need as a private market to be there, but I do think other will grow.
And then how much of the decline in retail and office sectors is due to value declines versus additions or subtractions from the property?
So, we're actually going to talk a bit about what was bought and sold over the year. So I'll cover that in detail. I would tell you, I think it's a little bit of both, but I'll cover that, as we go through the slides.
Okay. And then let me see, there was one other question that kind of disappeared off my screen, so I want to capture it. Hold on. No, I guess I got it all. Okay.
That's all right. And again, we'll pause here periodically, as we talk about performance, and I think that is a good kind of segue just into the market performance. As we look at an income and total return, with really the difference being appreciation or decline in value. Fourth quarter, you see we're back to positive returns, with appreciation. As we kind of looked at the cycle, 1Q was barely negative with depreciation, but a total positive return. 2Q, we certainly saw a negative total return. And then 3Q basically kind of back to the 1Q where appreciation, depreciation was flat, but the income really drove the total return. Again, I think in fourth quarter, you see the 0.9% income return and 1.3 total return. So a little bit of appreciation again, but primarily driven by income. And that really, I think, hides some of the true value declines we've seen, and we'll talk more about that as we dig deeper. But overall, for this cycle, the 1-year return is still positive, and at 1.2%, which was largely just driven by the income of the assets.
Now, we saw kind of some shifting in the composition of the portfolio. Is that having an impact on performance? Is it stabilizing performance more? In other words, the shedding of retail assets and the addition of industrial assets, is that having an impact on performance overall?
Oh, without a doubt. As we'll drill into the performance of the assets, in the property types, I think you'll see the stark difference. And overall, fundamentally, we've never seen property type performance divergence like we've seen. That we'll talk about some more as well. Also in previous cycles, we've seen, I talked a little bit about this last time, but we've seen really strong returns in previous cycles. Again, I don't think this cycle is necessarily like past cycles. So, I bring it up because I think we learn something from every cycle. This one, I think, will be different too, in that it could be a little more drawn out and a little slower of a recovery as well. But, we'll see. I think kind of transitioning right into the main point, what drove these returns over the last year. We wanted to look at kind of two ways. One is the max, we call it max drawdown or peak to trough value decline that we saw in this cycle. I don't think retail is any surprise. This is unlevered, by the way. So, you can impute or imply leverage by property type or, however you want. But on an unlevered basis, we've seen retail values fall by almost 20%. And really everything else was much more muted. We never saw industrial as a whole decline in value. And so, you see overall kind of headlines often in the middle there, the index only fell by about 3%. But I don't think that really tells the whole story. And when you really look at where we are today, on the left-hand side of this chart, with industrial and other are actually up peak to current, meaning, from beginning of COVID all the way to today, we've seen write-ups in those two sectors, where we've actually seen write-downs in the other three. And certainly office and retail were greater than the index as a whole. But when you really think about how much industrial buffered that total return, it's pretty meaningful. And I don't think, at least from my perspective, it's fully appreciated what discounts are in some of these asset classes.
Just a couple of things. Somebody asked, can we get copies of these slides? Yes, you will get a link to download the slides. If you do use them in your own materials, please provide proper attribution to IDR. And then you also get a link to a recording of this whole program. So if you want to view it later or share it with other people in your organization, you can. There also was a question about redemptions, but we're going to cover that later. So I'm going to hold off on that particular question. And then there's three more questions that have come in. One is, are these pre-post fees, and how are fees determined? What are they and how are they defined in the index? The index is before fees, is it not?
Yeah. So, and I'm going to stop sharing as we talk a little bit more here again. Again, these are just looking at asset values. So, certainly it's, you have asset value, you have change in asset value, you have income from the properties, and we're going to delve into that some more in terms of NOI and what these properties are really producing from a cash flow, perspective. But then after that, you have fees from the manager, and then you have the net return to the investor. So yeah, these are basically unlevered pre-fee or gross asset value changes. And then if the property is 50% levered and saw a 20% value decline, that means there's very little equity left, for example. So it's a much more impactful NAV decline if you look at it that way.
Yeah, and I think while investors are always interested in before and after fee return comparisons, all the indices are usually stated in terms of before fees, just to make for apples to apples comparison in terms of the underlying performance of the asset.
Absolutely. Totally agree. Looking at real estate performance, we always want to look at the real estate. And then at the end of the day, investors and indexes, the great thing about ODCE is we can look at it from a gross and a net perspective. So you can see a couple things. One is what should you produce for the investor, but also what is kind of the market and, what should my cost be to produce that return?
Right. Now, there's another question. ODCE has slightly underperformed the NPI recently and to some extent long-term. With modest leverage in a positive returning environment, one might think ODCE would be higher. Could it be an increasing number of specialty sector funds properties reporting to the NPI are stagnating numbers of the ODCE funds?
I think even in NPI, and again, I don't spend a whole lot of time on NPI given its separate accounts and a bunch of, but it is unlevered. So I think other is very small in NPI too. I think by definition, every time when you see value declines, unlevered assets should perform better. And right. I think it's dangerous to kind of look at it at points in time and not return series, because those time-weighted returns really have a big impact in the short term, meaning what's happened in the short term really impacts how the back end looks or the long term looks. So, as we come out of this recovery too, or if you look as you came out of the GFC, ODCE looked way better than NPI too. They go back and forth. So I'm not trying to defend one is better than the other. I'm just trying to say, I think more, it's important to keep in mind the point in time we're looking at these numbers. On a go forward basis, I think leverage is very accretive as you buy in today. If you looked at that a year ago, leverage was really not that all accretive. We were pre-COVID, we saw rising interest rates to a degree, lowering cap rates, and leverage wasn't really having much of an impact on total return.
It's always been a two-edged sword.
Agreed.
Any thoughts on the divergence between valuations as indicated by the REIT market and those from the NFI-ODCE Index?
Yes, we could have a lot of debate and divergence on that. So in terms of, REITs as a whole, I think, there's two arguments. REITs probably look like they're up significantly across most property types, but way down in retail. I think the public markets are not a great proxy to say real estate's going to end up here in 3 months, 6 months, or 9 months. There's a lot of forward-looking views out of REITs. And I think you're also assuming you went into COVID at exactly the same spot. So if REITs are diverging now, why weren't they diverging a year ago? In other words, I don't think REITs had valued retail at $100, just like ODCE was valuing it at $100 a year ago either. So likely, if you look at the numbers, REITs had a pretty good run up pre-COVID, and we're valuing that at $120. And so you're not going to see the same write down a year from then either.
There's another question about retail valuation changes. Do you have details for neighborhood, grocery anchored, or malls and power centers? And I believe that's the next slide, isn't it?
It is. Who asked that? Because I feel like they might have been looking at our slides.
How about we jump into the firm, though?
How about we jump right into that? Because I do think that was a very interesting kind of look. So here's retail as a whole, and retail is really the most diverse in terms of asset type and being able to break out different types of retail. And what we wanted to look at again were really peak to current, and then we'll show you kind of 2020 overall, because the decline in retail actually started pre-COVID. especially in the mall sector. So as we look at peak to current, malls are, actually down close to, or over 30%. And then, on the far other side, you have neighborhood and community centers, which is largely grocery anchored, down 7 to 14%. Again, peak to current. Now, what's interesting, I thought, were two things. One is neighborhood and community largely saw their write-downs here in 2020. So the majority of that write-down actually happened post-COVID, and I would say it was impacted by COVID. Malls were well on their way to this write-down pre-COVID. So I don't think you can necessarily blame COVID on the impact of malls as much. Jeff, we kind of talked internally too about what is that and why is neighborhood and community being impacted so much? If you think about, we're probably spending more time than ever at a grocery store. I know my way around the grocery store finally, just because we don't go out as much, and so the grocers are doing really well. I think the one impact, though, has been the inlines, certainly the nail salons or the other dry cleaners and the other ancillary services that rely on the foot traffic have certainly been impacted. And I think the second thing is really retail is just a dirty word. Any retail is viewed as bad retail right now. Which again, that could very well be a buying opportunity if you can stomach the exposure, and the property type kind of breakout or pie chart, with when you show people. But certainly malls have been hit really hard, and again, this is all unlevered. So if you think about leverage, there's some pretty significant value decline here, and why we think retail is probably going to 12% of the index overall over the next year or two.
Now, another question was, some third-party data and research notes that suburban offices seeing increases in leasing activity, while CBD offices not so much. Is the index more heavily weighted to office CBD versus suburban?
Yeah, no. So great question. When we look through to look at, and we'll talk about this in the performance too, even in apartments, for example, between suburban and urban. But in the office sector, about 40% of office in ODCE is suburban. So, when you think of office and MSA exposure, those MSAs tend to be fairly big and include the CBD and those secondary suburban locations. And so I think office, that's one of the surprises and fundamentals, I wanted to talk about in a minute here.
Now, you also mentioned, that you presented some data sets that were off from peak. Which quarter represented the peak?
So in terms of peak property values?
Yeah.
So in the data set peak to trough, that's taking the most recent peak values. So for example, in retail, I believe it is early 2019 was actually peak value for retail, whereas like industrial just kind of kept going up. Every new quarter is really a peak quarter for industrial.
And on the office side, do you expect another decline in valuations moving forward when transaction volume picks up again?
That's a great question. And I think that really, gets very nuanced as you look at or very asset specific as you look at values. What we have seen sold has been sold at or slightly above carrying value in the underlying funds. So what's transacted has said the values are right. And I know we'll get into this in a bit and go down, a path of where our values, but it doesn't mean everything could sell at NAV either, right? So I'm not trying to say that, but I think as you look at kind of how this plays out, we need to see how COVID plays out. We need to see how a number of things play out. Every point in time, I think looks a little different based on your assumptions on how we come out of COVID.
Along those lines, though, one of the people asked, do you think grocery anchored centers will struggle after people get vaccines and start to go out more instead of relying on home cooking?
I'm ready to go out. Yes and no. I think, in a way, some of the things that are grocery anchored are really kind of Amazon, in my view, Amazon proof. You can't get your nails done at Amazon. You can't get your hair cut at Amazon. And, there's certain services. You can't get your dry cleaning done. So, some of those service oriented things I think will come back and actually be a big impact. And they're probably the highest rent payers, right, in those centers, where the grocery stores have been great because, they're doing well, but they're not largely paying you more rent because they're doing well. So I actually think the grocery anchored centers and we're going to delve into this next section shortly here on property types and fundamentals. I think you're actually going to see increasing NOIs as some of those things come back online. At least across the ODCE Index, as we've talked to managers, I think the managers have been very, very focused on being good stewards of both capital, but also landlords, and tenants. It's going to cost a lot more to just replace a tenant, going forward rather than just helping your existing tenant. They can't control COVID. And so most landlords, I think, have been really great, at least the ODCE managers who have this capital base and ability to do this, have been really very great with, and proven why you want them as a landlord even, because they can ride this through.
Okay, thanks.
So with that, Jeff, how about we maybe jump into property type fundamentals here a little bit?
Yeah, somebody's asked another question about Qs. We're going to get to that, so just hang in there. It's one of the areas that Garrett's going to cover down the road. So now we're looking at CapEx.
Yeah. So we thought we'd look at both sides, the spending side, CapEx, and the income side, NOI, and drill into that a little deeper. I thought this was just good for perspective. This, I don't think, tells you about changes because it's just total dollars of CapEx being spent. Index values have gone up over time, so you would expect more CapEx, but you can really see the breakout, and how office really dominates that CapEx, expenditure across the market.
Are landlords spending more? Are owners spending more, or in terms of spending more money than they otherwise were before, or is it more a reflection of rises in labor and materials costs?
So I think it's both. I think labor and materials have had a much bigger impact on development, and that's a whole nother topic, I think, in terms of where's replacement costs gone. But I think, certainly as you look, at CapEx, just as a total, it's gone down because, we're spending less money on our assets right now, just in summary. And whether that's cost reductions, I haven't seen a ton of cost reductions. So I think it's largely just, trying to buffer the loss in income right now. As we look at this from a year over year change, which I think is a little more interesting, what surprised me most was how big the apartment and industrial and office CapEx actually went down this year. I think we largely saw the cuts to CapEx already in 2019 as retail started to struggle. I think the other thing is in industrial, it's just so heavily leased. There's not much to do with these boxes. So, they're CapEx light to begin with. They're leased. You're not spending much money. So, overall, I think, we've seen a really dramatic cut in that CapEx number, and that's costs across the board. It's not just TI, but I think cost savings is a real kind of piece of the total pie here, and that certainly the next part of it is the NOI change here on the left. And again, this is what surprised me on this NOI change was, I expected retail to be down, but apartment being down so much and an office being up at all. I really expected office to look more like the apartment number. So I think, as you look at what's driving some of this performance, I think it's not necessarily what's always consistent with market sentiment.
And one of the questions that's on the table, TIs obviously are included in this CapEx comparison, and that could be, the declines could be related somewhat to a reduction in leasing volume. But what about lease commissions? Are those included in these figures, or are those something else?
We can confirm that. I'm going to ask our data guy, to be honest, but I'm pretty sure lease commissions are part of CapEx and part of that calculation.
Okay. Right.
You're really drilling into the numbers on me, Jeff.
Well, I'm not. I mean, the participants are asking these
questions.
I
know. It's all right. Here's another way to look at NOI. And again, kind of thinking about what surprised us and what didn't. The retail was certainly expected, but I think apartment, to me, was not expected. We think of apartments as holding their value and fundamentally being pretty strong. What we really see, if you dig into this number a little more, is the kind of city center and the New York and San Francisco's being the really soft area. Historically, the Atlanta, Georgias of the world, are where you don't want to be in a cycle. But I think those have been much more attractive locations where the city centers, we've seen the population kind of not want to pay for the premium rents because they don't need to. They don't need to be there right now. I think that's both an opportunity as well as we come back through the recovery. I think you could see some really pretty strong recovery in your NOI as well.
Okay, so what you're saying is that the fall off in NOI in office and the apartment sector really is more related to softening in some rental markets that are driving the indexes.
Because given apartments just have a 1-year lease or so, right? So that can happen a lot quicker. Office, interestingly enough, is up. And again, I think that's the benefit of longer term leases. Companies might not be in their space right now or have people in their space like they did, but they're still paying the rent largely. And those lease terms, I think ODCE has about a 7-year weighted average lease term. So there's some real time to go through, and figure out what that looks like on the other side.
And you do expect these returns, at least in office and apartments, to reverse once COVID is passed?
I think once COVID is passed, I certainly expect the apartment to recover. I think it's too soon to say I expect a big drop in office. These city centers have been really resilient in the last cycles. Now, whether that's a, immediate rebound or a longer term rebound, I think it all depends on your view on how COVID plays out. But, you certainly have the work from home dynamic, but you also have the density dynamic where I don't think you can be as dense. And I think you probably need multiple locations if you believe COVID's here to stay and that issue is here to stay.
Going back to the CapEx numbers for just a second, there's an interesting question somebody posed, which is, do you think we'll see a backlog in CapEx and fund managers are only spending CapEx defensively? In other words, we talked about, rental volume, new leasing volume is down. That might explain part of the reduction in CapEx. But are people holding off on making, deferred maintenance type decisions?
Yeah, So I think it's a bit of everything, right? And I really think that's where you got to start drilling down into age of the assets and specific portfolios because, I think on one hand, yes, you're probably deferring some things and pushing things off, and you don't want to spend money unless you get a return on it, right? So it's hard to justify spending money right now. At the same time, I think you have a lot less usage of your assets. So you probably don't have as much maintenance and as much just because no one's there.
Not as much work.
so
Sure.
so I agree. I think it's probably a mix, and I think it really depends on age and the asset.
Okay.
Uh, Maybe we'll delve. Last time we talked about rent, and I thought it was just a good kind of summary recap. Rent collections are largely unchanged from last quarter. Certainly up from the bottom. Kind of we look at March or April as kind of the bottom of the cycle, or at least collected. And you can really see that I think across the board, they're remaining strong. Apartment and industrial and office are really kind of unchanged, and if not slightly up.
When you're looking at the apartment sector, have you been able to drill down and differentiate between different types like CBD, high rise, suburban garden office type, garden apartments and that sort of thing?
Yeah, absolutely. I just didn't highlight it just for time's sake, but when you look at apartments, there's really three categories of apartments. There's garden or low rise, mid rise, and high rise. And then you can certainly categorize it, and we've looked at it from urban versus suburban locations. With certainly the high rise generally being almost exclusively urban, major infill locations. Uh, Over the last 10, 15 years, the garden is by and far the best performer. Even pre-cycle, the garden at type of properties have just outperformed the bigger assets.
And how about COVID's impact on investments in things like HVAC upgrades to improve air quality and those sorts of things? I would imagine that's going to be a big deal for tenants to continue to renew leases and for tenant employees to want to occupy the space.
Oh yeah, without a doubt. I think that's where it's starting to filter in, and we really probably haven't seen the full impact. I think most companies were trying to just push the ball down the road a little bit here, for the 2020 for sure. But I think when you're buying assets, it's gonna be on your underwriting checklist, right? Do I need to upgrade it, or can I knock them, for value? I think as a tenant in your RFP, it's going to be on the list and a checklist item. So I think that's certainly more to come. The question is, is it a long-term or a short-term kind of impact?
And again, we kind of addressed this, but just to go back over it one more time. If you look at NOI growth in this presentation next year, do you think that apartment NOI declines will snap back? And do you think the office NOI growth will turn negative? And again, nobody has a crystal ball per se, but you've got to have some opinions on this, what you think is going to
happen. Yeah. So, I think that's a great question, and I'm going to answer it a little bit in terms of the base rent. Because I think fundamentally, at the end of the day, the base rent here is what's going to drive where things go. So, as we look historically, in 2020, base rent went down, 0.5%, because what was that driven by? It was driven by retail largely, and then apartment. I think apartment probably is stabilizing. I think you can argue in certain cities maybe down and others probably up. How that kind of plays out on a weighted average, I think, is flat. Retail, again, do you think that's flat or going down some more? And then lastly, office. What surprised me again was how strong that office base rent was this year. That actually went up. Again, I think it's built-in lease escalations and built-in, fundamentals of the asset class, where apartment, adjusting more quickly. So if I look at where do I think this ends up next year, I tell you, I think retail doesn't go down as much. I think office could be slightly down, but I think the rest kind of covers for that going forward. But I think it all depends, just like your return expectations. What's your scenario for the recovery with COVID? The public markets, have been going back and forth, certainly this week, and trying to decide what their opinion on that is. But, and I think maybe we'll cover this. I'm sure it'd be interesting to talk about total return expectations, but I think a lot depends on your COVID scenario.
And there was a question about base rent definitions. You're talking about face rent, or does it include concessions? What's your definition there? Or how does NCREIF look at it?
I think base rent in this, as we're looking at it, base rent is just kind of net lease rate. So it includes, anything from concessions to, deferred rent. I think, also you got to account for some uncollected rent this past year. I think you'll probably get some of that too. So, I think that's a double-edged sword as well.
Okay.
This, I kind of alluded to this earlier, but, we've never seen the property types perform so differently or have such a wide disparity of performance. If you look back to the early, 2000s, you see that green line really high. That was actually retail and specifically mall outperforming. And then as you look at this cycle, it's actually on the gray line. So, and certainly industrial is the green line up top. But what we wanted to do is just really look at the best performing sector and the worst performing sector. And we've never seen such a disparity. How that plays out, last time I showed you, industrial had performed, or been the top performer, I think 4 years in a row. We never saw that consistency either. So I think, we're interested, and we're certainly not saying what, we believe industrial is overvalued or anything like that, but it's going to be very interesting to see how this cycle kind of, transitions, because I think history has always shown us if it's worth building, you can build industrial pretty quickly.
And there's a lot of industrial being built, is there not?
There is, but it's to meet demand right now. So, I'm not by any means saying I don't believe it's, warranted. The fundamentals are really strong, and the e-commerce case, makes a lot of sense. I just feel like at some point when you're buying 2 caps on one side and 8 caps on the other, that income means a lot to you.
Okay.
Lastly, and this is the last part of this section, but we talked about in the last review, we talked about kind of the cap rate spread to treasuries. We want to spend a little more time on that and dig a little deeper, especially in light of kind of some of these valuation discussions and questions, and where does real estate fit in kind of the overall capital market discussion. So what we did here is we wanted to look at historical average spread. The blue line is that cap rate spread to treasuries, and then the gray line is the single B bond spread to treasuries. And so the 1x just means that's the historical average spread over this time frame that you would see. And as you would expect, it goes up and down based on sentiment. So if you look at previous cycles here in yellow, what you see is really the corporate bond spreads, public markets, especially bond market, is usually ahead of us and usually foreshadowing where things are going. You typically see the bond spreads decline, go below historical average as things recover. And so certainly in the last three cycles, we saw that. And then real estate has followed. This time around, we're arguably in the middle of it. We don't know exactly where we're going. But what I found interesting was, the bond market is certainly saying we're past the worst of it. And the spreads are going towards historical minimums, really. So you can see here in the gray, bonds are saying the spread should be below historical norms. And real estate is still, largely well above historical norms. Someone's wrong. Someone's right in terms of where we're going. I believe the bond market has always been better at this than we have, but we'll see. So I thought it was, kind of a good food for thought.
Interesting. So
I'm going to pause there for a second, Jeff, and see if there's any more questions before we'll go into capital flows kind of next.
Well, a lot of the questions that are coming up are related to capital flows and Qs. So I'll kind of hold off asking those until we get into the presentation, then I'll follow up and ask them. So hopefully we'll keep them on the screen.
Okay. Well, then we'll jump right into it then.
Well, there is one question I'll ask. He says, I guess economic data from places like Bloomberg, consumer spending, and other financial reporting data that could affect property asset values is used when making decisions into what property assets or sectors to increase or reduce exposure. But then daily movement data from people and cars to commercial property, retail property, et cetera, could be relevant to determining asset value. Not really a question, but I guess what he's basically saying is that are these kind of economic forces the things that are driving the shifts in various mixes, decisions to acquire or reduce exposure to particular property types and that sort of thing?
Yeah, yes. I mean, I to a degree, I agree. I think you're talking about big data and analysis, and I don't know, supercomputers, I guess, to figure out what that all means. I think, high level, you certainly see industrial growing because of the, e-commerce trend, right? So I absolutely believe that'll continue to evolve, and, high performing, portfolios will see that earlier and transition to those sectors earlier.
And are you seeing mall or office space being repurposed, like to industrial, other uses?
Yeah, I mean, I think yes, especially on the maybe mall sector, but I don't think it's good if you own a mall that's repurposed to industrial. I mean, we saw that here in Cleveland, where they tore down a 1960s mall and put an Amazon distribution center on it. I don't think that was a good outcome for the mall owner. I think it was a great outcome for the industrial developer. So I think, those aren't the type of assets, hopefully, in my opinion, that ODCE owns and is in ODCE. So I think, these assets are largely, performing as intended.
Okay. All right.
So dispositions, sales for the year, I think it was I thought it was interesting. There were a number of sales, and even though industrial is such a hot sector, I think there was some pairing of portfolios, some liquidity being generated, and so even on the disposition side, industrial was kind of the biggest sector.
Is this dollar weighted, or is this just number of transactions?
So these are transaction weighted, or well, just based on number of transactions.
Okay.
I can tell you, and hopefully you're not seeing my cheat sheet there, but I can tell you that from a dollar basis, we saw um, actually industrial was still the biggest at 54% on the or I'm sorry, industrial was one of the smallest at 16% of dispositions. On the acquisition side, industrial again, no surprise on a number. From a dollar perspective, industrial was 54% of the assets bought. So, it was actually a net buying year still. More assets were bought than sold across the index. And in the second biggest dispositions, actually the biggest dispositions were apartments last year. So 40% of dispositions were apartments by dollar amount. And then in terms of acquisitions, same thing. Actually is about tied. Multifamily and office were about 18 and 19% respectively.
Okay.
From a pure net capital flow perspective, still a net outflow in terms of pure just dollars coming out. Although I would say it was, encouraging here at end of the year to see both the blue shaded area and the gray to grow again, as dollars are coming and going. But contributions and dispositions, and this is money coming in and out of the fund itself or underlying funds of ODCE themselves. So relatively liquid, about a little over 2 billion coming in and about close to 4 billion going out. And then finally, we talked about this last time. Redemption queue impact. This is post-COVID, so taking basically end of 2019 and looking at what happened to queues static from there and how they grew or declined post-COVID. So in 3Q, we saw about a 6% standing redemption queue across the index. And that came down slightly to 4Q. It's down to 5% now of waiting money to be redeemed. In the fourth quarter, we saw 12% of redemptions satisfied on a weighted average basis, but on an equal weighted basis, on average, we saw the funds pay about 20% of their redemption queue.
And how do you think investors are feeling about that? Okay, it's all right, or are they feeling frustrated?
I think it's a mix, and I think it depends who, we all have a responsibility to fight for, our constituents and what's best for our, our members and, as investors. So, I think some are frustrated. I think others are, feeling better about it depending on their liquidity positions. We also saw a fairly robust secondary market through the year where, if people really wanted liquidity and felt strongly that values were incorrect, they could sell in the secondary market. So we saw a couple $2 billion of secondaries, transact, which again, I think is great for the market as a whole in that it's another liquidity source and makes things more liquid. But there is a price to that. And if you believe that, kind of tells you where values are too. You're seeing very little, if any, discount, in the secondary market now.
Okay, now we're getting up against the end of the hour. I know there's more questions. We're not going to be able to get to all of them. But if you were going to look back on 2020, what would be maybe kind of your conclusion about the net view on the market? And then looking forward to 2021, where do you see things heading, and how do you think 2021 will end up?
Yeah, I think that's a great question. I think as a whole, I think the market proved its resilience and proved that it's a asset class that should be relied upon by investors. It was uncorrelated to the public markets. It continued to provide income and kind of continue to provide say this is an oxymoron, the core mission of real estate, which I think is income and non-correlation and inflation protection. So I was, I think everyone kind of worked together to make that happen. Everyone from property managers on up and through some pretty tough times. So I think investors as a whole are pretty happy if they had real estate in their portfolio.
And looking forward, what's your view? How do you think things will end up?
I think that third piece of the pie that I mentioned, that inflation protection is going to get talked about a lot more, along with the income component, as the money supply has been dramatically increased. And, we talk about life after COVID and the recovery, how long that takes. No one really knows for sure, but however long it takes, I think when you do see the, recovery, it's going to lead to more inflation, and income's going to be, really important.
Great. Okay, so we'll see you again in April or May when we get the first quarter numbers in, and looking forward to finding out how the first quarter shapes out.
Same here, Jeff. Looking forward to it. Thank you.
Thank you, Garrett. Take care. Bye, everybody. Thanks for joining us.